Bloomberg Radio Plus app, free for iPhone and Android devices.
David Kelly, Chief Global Strategist at J.P. Morgan Funds in New York. Good morning, David, and thanks so much for joining us. So what looked like a threshold is apparently not a threshold after all, and there are questions about what the Fed's threshold really is at this point as the jobs picture here changes. What does that say about the credibility of forward guidance from these central banks? Is there a risk that investors could lose their trust in what they're being told, or did that happen a long time ago?
No, I think this is something new, and I think this is a policy that has not really been tried out. I think central bankers have a tendency to, move as a herd and think up of some plan, and then all agree that this is a good thing to do. Actually, there's a problem with what's called data dependence and forward guidance. What both the Bank of England and the Federal Reserve say is that they'll watch the data and they'll adjust a policy as appropriate, but they also then put out these targets or these forecasts that they won't raise interest rates for a very long time. Now, the problem is that if your forecast of the economy is wrong, then it's clearly inappropriate to stick with the original policy. And I think both the Bank of England is having this problem. I think the Federal Reserve will particularly have this problem because the unemployment rate in the United States is simply coming down faster than the Federal Reserve expects or really understands. But it does say that the Federal Reserve ought to be raising rates faster than they currently plan to. I think the Bank of England has really got the same problem.
And Governor Mark Carney is maintaining his push to convince households and businesses that higher interest rates are still some way off. So is the Fed, for that matter. But does that carry a big asterisk, do you think?
Yes, it does. And by the way, what's the point? I mean, if you're trying to stimulate economic growth, is it a good idea to say that interest rates will be low for a very long period of time, so you don't need to bother borrowing today? You can just wait a while, or should you tell people that interest rates probably are going to go up pretty soon? So if you want to buy a house, start a business, borrow some money, do it now. I don't even understand forward guidance. It seems to me that if you want to get people to engage in some transaction, you tell them the price is going to go up, not that the price will be low forever. I don't think it's a sensible policy, and I don't think it's fundamentally a coherent policy either.
Well, they did seem to be able to lead investors around by the nose, if you will, for a while. There was some trust in that forward guidance.
Well, I think there's, we've seen long-term interest rates move up in the United States over the last year appropriately. They haven't moved up enough yet. But the Federal Reserve has been a relatively soft global economy up until recently, and I think we've got plenty of slack in the economy, no real inflation, so it hasn't been hard to keep interest rates down, particularly with all this bond buying. But when you stop the bond buying and the economy heats up, it's going to be more difficult to keep long-term interest rates down just on a promise that people don't really think you're going to keep.
Yeah, I'm going to pause it right there and roll it forward. I usually don't like to let this go on too far, but this gets pretty interesting towards the tail end of this Bloomberg snippet.
What's your view now, having heard the testimony yesterday, on the pace of tapering?
I think the Federal Reserve will stick to the pace of tapering that Bernanke seemed to outline when they started, which is that they will cut bond purchases by about $10 billion each meeting, which will take them down to about zero by the end of the year. The real question is, when do they raise the federal funds rate? The Federal Reserve is trying to propagate the idea that they won't raise the federal funds rate until late 2015 or or sometime in 2016. But I think that if the unemployment rate falls enough and if wages begin to rise enough, it's going to become apparent that that's waiting too long, and that's when things are going to get very interesting for the bond market.
She did talk a bit about inflation. Do you think that that's high enough on the Fed's radar screen?
I think the Fed is always concerned about inflation, as it should be. The problem is that inflation is a lagging economic indicator, and the truth is that if you think that inflation is going to go up, you have to have a tighter than normal monetary policy. And the problem is that not only do we have an easy monetary policy, we've got a much easier than normal monetary policy. And getting back to normal, even when you start to raise the federal funds rate, will take you about 2 years. So if you don't start till 2016 to raise the federal funds rate, you could be 2018 before you get to a normal federal federal funds rate, or even at a neutral monetary policy, and by then inflation is well out of the bag. And by the way, you will also have asset bubbles. I think even worse than inflation is the distorting effect that this is having on savers, on home prices, on stock prices, on asset prices of all kinds. You are begging for an asset bubble if you keep short-term rates this low for that long.
Okay, that was pretty interesting. Hello and welcome in from Sunnyvale, California. I'm Mark Vierra. This is my weekly technical analysis video. Usually don't like to let those snippets run too long, but thought that was pretty interesting. So let's see. In this video I'm going to cover just some basic long-term, intermediate-term, short-term chart trend lines, some moving averages, fib extensions, look at some fib numbers, and some volume. Just go over last week and throw in a little projection of where I think the market's heading. I do like to mention that this video is not any buyer selling recommendations, just educational purposes only. I think it's probably a good idea to mention too, just as a disclaimer, that I am long the stock market. I do have some long positions in there, and I have links in the YouTube. If you want to check out my trading log, you can see what I'm actually trading. But in this video, let's just look at some charts, some basic trend lines of some monthly S&P 500 chart, taking a wide lens view, and then I'm going to zoom in. So here I'm zooming in on the monthly chart. We had this lower shadow, just perfectly respecting this previous trend line that I've drawn. That was a good stop running, and now on the SPY, this is actually engulfing the previous candle. On the S&P, it's just tagging, it's tempting this resistance level here, and setting up also for a nice long-term chart pattern, which would be a bullish flag event going on. The daily charts, I don't have much anything really for chart patterns, because when we get into that, the daily charts, just a parabolic leg, and you need some zigzagging to get some patterns. But I do see a bullish flag developing here on the monthly chart, and I have some measurements on that. What I like to see too out of these chart patterns is this false breakout. So that pretty much tells me, the market operators will like to take price one way, fake you out, and then of course we saw it this week, just explode to the upside. What else can I say about the monthly chart? Almost kind of a tweezerish type of piercing pattern, which is really good at pointing out a bottom. So I would say that anything down in this area, well, actually, it's still this monthly candle is still in play. So this would be our longer term trading range within these two areas, and we'll see if we get any upside. This is also showing me that this 1900 level is coming well into view, so that's something to look forward to. One of the other long-term chart patterns that I've had, and I've been looking at this here for a while now, and this 1866 is also a target that is getting closer. Here's the monthly flag, and what I want to say about these chart patterns, and you've heard me say it before, is they will oftentimes give you a false break, and then the chart will move, the price will move to its next respective target. In this case, came pretty close, I think, to the 1734 downside target, and I do believe that we have a good possibility of seeing this 1900 for a long-term upward target on this flag. Next up, weekly charts. Let's take a look at some weekly trend lines. So this chart is just showing you a wide lens view. You can see where I have this blue dash long-term pivot and this orange trend line, and then I'm going to zoom in where I have some other trend lines drawn in. This is marking a weekly intermediate term channel here. All right. Now, I mentioned candle blending, and if I take and I blend these two candles together and I blend these two candles together, I get one heck of a tweezer pattern. And this is just great to see this stop running here, because I know that the move upward, okay, is going to be a strong one. This last week's candle was an excellent bullish tweezer pattern, and this candle here confirms that tweezer. So that's just a confirmation to this tweezer that I'm pointing out. Now, these broadening patterns, I do want to mention, it is probably one of the worst performing chart patterns. And I'm going to show you a weekly flag, and it's a high and tight. High and tight flag is probably the highest percentage at meeting target. It's one of the more reliable chart patterns. But broadening, and when you see it up at the top, it's considered a bearish pattern. When you see a broadening at the bottom, it's considered a bullish pattern. But these or also called megaphone, they're near random, really. They have a very poor track record. So here's our blue pivot. All right, we had a strong pivot above, and we're going to find resistance, of course, near the 1850 area. That's where we're going to find strong resistance. I do think it will be breached, maybe not this week. Get into volume, and last video I was calling for a little bit of late to the party buyers and then some consolidation. We did have some consolidation. I'll get into that later, but really not much to speak of. This week, I'm bullish on the market, and I'm hoping to see some consolidation. I think that would be good for my, long positioning. What else can I say on this weekly chart? I think that's pretty much it. Let's take a look actually at that flag. So before we get into that flag, there is something interesting to note. And it's amazing. A head and shoulders pattern is a bearish pattern, and inverted head and shoulders is a bullish pattern. You usually find inverted head and shoulders at the bottom of a market, and you usually find a head and shoulders at the top of a market. Well, it's just amazing here. If you look at, we have a left shoulder here and a right shoulder here, okay, and a head here, and we went off to make a target in that inverted head and shoulders, and I'm seeing the same kind of left shoulder developing. And if I'm right this week, and we do see a little bit of some consolidation into that flag that I keep saying, bull flag, bull flag. Well, that would put a very similar right shoulder as we saw back here. So yeah, it's crazy market to see, and on the weekly even, to see a inverted head and shoulder at the top of the market. That's just amazing resilient market to see that. Also looking at measured move. This is an upward measured move. Here's our initial leg. We had a little ABC consolidation within the leg, which is natural. Could see the same thing around here. And this would be your main corrective pullback. And then I add the measurements to here. This would be your equidistant target. So could be looking at a continued wave upward. Here's another chart pattern, weekly round top, and this is always, it buys into my conspiratorial chart patterns. Want to give you a false break, which we did. We got our downward target, and now we're moving up. This would be your confirmation break to the upside on the weekly round top, and is something that I think is a distinct possibility, especially when I combine volume and other chart patterns that I'm looking at. Here is the high and tight weekly flag. Flags in general are pretty good, but the high and tight is just phenomenal in terms of track record and price meeting target. And here would be that false breakout, and now we're right back into the flag area. So confirmation break above the 1850 would put this pattern into play. Alright, so we've got some pretty good longer term chart patterns, but I am seeing the market showing signs of slowing down. Get into some composite profiles to look at that. Let's take a look at, so this is just a basic daily trend channel, and it's a daily chart, but I would consider as far back here would be more of an intermediate time frame. Gives you a better also look at how the left shoulder and the right shoulder over here is developing. Let's zoom in on that and see our range. And here I'm marking just a basic top resistance trend line, and I'm actually hoping that we get a little bit of consolidation into this range before moving upward, because if we keep continuing parabolic, we're just, for a bullish scenario, it's not going to make much headway. Eventually, this rising wedge or parabolic leg will have a significant pullback if it continues, in the speed at which it's traveling. Always speak of the market in terms of speed, and it's really, you can't tell when the market is going to slow down. Nobody can tell you that, but right now it's still moving fast, and I do see some signs of slowing down, and we'll get into that later in volume. But here is just a basic trend channel, and I'm expecting some respect paid to these trend lines, and that's what I'm expecting. So let's see, what else we got? Daily regression, Andrew, moving averages. Last week I had pointed out these short-term moving averages. This is a 5, 9, and 20-day moving average, and I had marked where let's see, I had marked where the 9 actually crossed below, or you could say the 20 crossed above the 9. This time I'm marking now where the 9-day is crossing above the 20, or the 20, whichever way you want to look at it. But after we've seen a cross, this is what we had, this upward movement. Same thing over here. And I do believe that we are seeing the same kind of action developing there. It hasn't happened yet. Waiting on that. Now, this is a 20, 50, and 200-day moving averages. This is more or less your longer term moving averages. And I'm marking down here where it touched the 120-day moving average. These are standard or simple moving average. Crossing below the 100 over here, and what we had afterwards. Of course, that's no guarantee. I'm just looking at what previously has happened. Alright, and these white arrows here are marking where the 20-day fell below the 50. Alright, 20-day fell below the 50. And same thing we have here. So just previous cases of the 20-day cross, 50-day moving average, and the price has always managed to come up and touch the top of the Bollinger Band, here in this case and here in this case, and I would expect nothing less than to come up and kiss the top of this here Bollinger Band. So that's what previous long-term moving averages have pointed out. Now let's take a look at some Fibonacci numbers. I don't have a retracement because price is still moving upward. What I have is a Fibonacci extension where I'm going from the lows to the highs, and from there we have the pullback leg, corrective leg, and 50% is where I always find a key level, and that's another back of my mind telling me that we could see some consolidative resistance here, and maybe this is where the boy who cried flag is going to get his flag. Eventually, I think we are going to see some consolidation. So, haven't seen it yet. Still very much a fast-moving market. So here I have a daily chart pattern worksheet. And we had this steep decline, this falling wedge, which we broke out of the falling wedge. Pretty much building a new rising wedge, which I marked up here, coincide with the weekly chart too. Possibility of putting in a right shoulder here at the top. It's kind of hard to see shoulder-wise the way I have this thing zoomed in. But I was expecting last video, I said we were going to get some consolidation, and this was the only, it's not much of a flag, but, I'm going to take what I can get. So we did a little bit of a consolidation, but not really much to speak of. Candle bodies are getting a little bit smaller in length. All right, we'll get more into the candle body length in volume, but that's one of the reasons, just to point that out early on, that I do see some slowing in the market. Not much, but the speed eventually will have to slow down. That's just inevitable. And I am expecting some back and fill consolidation, and a fine spot for it would be at the top of this broadening pattern. Here is, on the weekly, showed you the broadening pattern. This would be what you're looking at on the daily. So what else can I say for candlestick analysis is there's no sign of the market slowing. You can't ever determine when it's going to slow down. But we will look at some volume next here now and see some signs of some slowing down in the speed. Okay, this is a daily volume chart using SPY. It's an ETF that tracks the S&P 500. This is where I'm getting my volume from. We have a 3-month point of control. This is where most of the volume by price, these are volume by price nodes. That's where most of the shares are changing hands. We call that a point of control. We have outside of that point of control value area set up. That's in the yellow. And our profile boundaries, upper and lower profile. And the last thing I have in here is volume weighted average price, VWAP. So those are the indications in the upper part of the chart that I'm looking at. And again, this is volume by price. I think we're showing this volume node is support right now. This is volume by time down here, and one of the biggest clues that I have for consolidation is declining volume as we're moving upward. Okay. On the hourly chart, which I'll get into next, it's a little different. The other thing I'm looking at too is my oscillator down here is putting in lower highs with this move upward. Is a little bit of some, foreshadowing a little bit of some bearish divergence going on. So what I got written is institutional demand volume not letting up with no sign of candle body length per volume discrepancy. There's no real discrepancy, but I do see a little less of a volume candle body length than I see here on this one, and it's about the same amount of volume. So not much of a discrepancy, but let's get into the hourly chart next. Here on the hourly, I'm showing that we're still increasing intraday on the move upward. See how the volume is increasing on the move upward. Here I'm seeing volume increase on the move upward, but not as a steep incline as previously. And that's about the only clue I have, except for now the lower RSI highs is a little more distinct here on the hourly chart. So that's showing a little bit of bearish divergence, not much, so that would fit within my thesis of the bull flag. I am going to get my bull flag one of these days if I keep saying it enough, right? So, oh, forget monkey bars. Let's look at a composite. These composites here are pretty telling, and what I have here is this is a monthly composite. These areas are monthly areas, and these are what you call daily aggregates. So price is right above this previous month's TPO. So that's a high volume area. There's also a high volume node right here. So between this high volume node and the previous TPO, I'm looking at somewhere in that area for a new bell curve. Bell curves are what volume makes as it's testing upper and lower areas, and it forms this D-shaped bell curve just naturally. The way traders are fighting over price, and what I'm expecting is a D-shaped, profile composite to be formed in this area, going by the previous volume and the previous bell curve that was formed here. That would give this what is known as a P-shape composite profile. So that's what I'm looking for. And on the weekly, let's go into the weekly composite. So that's where I'm drawing this, is where I think we don't have, this is last week, and this week will be over here in this area. And I'm drawing this oval here where I'm expecting the bell curve to form. Now, previous week, you got sort of an E. Okay, not much volume here, but this would be your E shape, and I think that we're going to start off the week at least with a bell curve forming up in this general area. This is right above the point of control, and our initial balance was way down here. This is how we started the week's trading. Then our take profit developed here, and this is a 30-day hourly point of control that price is above right here. So I think it's building a better foundation in terms of structure. That's why I'm saying that our bell curve will be forming above the point of control. Of course, it's hard to predict a weekly composite. Really want to see what the initial balance is going to be for that week first. But that's my prediction in terms of profile composite. And let's see, Treasury bonds. Treasury bonds, I'm doing a monthly and a daily chart, or actually a weekly. See if that's what I've got. Yeah, I've got a weekly and a daily. Looking at treasuries, this week we have testing supply down here and an indecision doji right at our 9-month point of control. What I'm expecting for bonds is I think we're going to have a pretty tight trading range. I'm actually expecting a little bit of strength in bonds to start the week, but I have a suspicion that we're going to see some longer-term weakness in bonds. Right now, we're looking at a supply test, and I think we were successful. Meaning, it's kind of an opposite way that we speak of a successful test of supply as no supply, which you would think that it would be termed the opposite of that, but a successful test of supply is there's no supply in the market and we're looking for higher prices. So I expect that we're going to see probably a tight trading range, but I think we'll head probably up higher to the top of the VWAP channel. These dots are my VWAP channel. Price is right at VWAP. 6-month point of control is down here, and I'm looking at a head and shoulder pattern in the background too. I do believe we will see some tight trading range, but I suspect that this neckline here that I've drawn will be respected, and 105 I think area, maybe 104 half would be a more of a longer term outlook for U.S. Treasuries. Do have a little bit of bullish divergence too. So I think on the near term we could expect some strength, more or less probably a shallow trading range for bonds, and I'm expecting more of an intermediate term weakness. So that's what I'm looking at for bonds. Treasury yield is I think in favor of the bulls here. Came down to some lower levels, and I keep saying how low yield is going to make stocks look more attractive. And if we look at previous highs on the yield, it shows us that there is still plenty of room for that yield to run higher. So let's look next at the US dollar, and got it in here somewhere. Got a monthly view of the US dollar actually. Take a look at this symmetrical triangle. Symmetrical triangles tend to be bullish. I know we've got a lot of people calling for a lower dollar. Of course, that would be good for the gold bugs. I do see there is an engulfing candle on the monthly here, engulfing the previous candle. And like I say, these chart patterns do like to break downwards. But ultimately, I have respect for the resilience the U.S. dollar has shown. I expect the U.S. dollar to stay relatively strong, if not just generally stable. You have it as a default safe haven reserve currency that likes to prop it up. You've got central banks that want to prop up the dollar. It's got all these fundamental reasons for a stronger dollar. And of course, you got fundamental reasons too with a Fed intervention for a weaker dollar. But weekly is looking bearish for the dollar. We have these two long bearish candles. I think we'll at least come down and pay some respect to this trend line. So a little near-term weakness on the dollar. And then if I look at the daily chart for the dollar, take a look at that. Zoom in. So what the near term is telling me is I have this bearish flag that is in the process of working itself to a target. So see some near term weakness in the US dollar. Broke below this is a pretty good trend channel that it broke out of. So I think near term weakness for the dollar is in order. And of course, looking at the euro, sort of see an opposite mirror image of that. And I'm sort of glad too. I have a gets to $1.38. I have an alert set for that. Opposite view of the U.S. dollar. We have a bull flag and it's working itself out. So hopefully we'll see some strength in the euro. I would love to see that. And that's all I've got. I want to wrap this video up. I think the stock market this week, we've got a short week, will probably be relatively flat with, I think, a slight upward bias. And here is HotStockMarket.com. This is where you can go to my trading log. I'll have links for you. You can see what I'm actually trading if you're interested. Also want to point out, a good place to find resource and information here is Reddit, subreddit Stock Market. And that's it. And I hope to see y'all on the boards.